Okay, so today we're doing a deep dive into Capital Alphabet. We've got their fact sheet here, and we're really going to look at their strategy and their performance since they kicked off back in June 2022.
And the performance is definitely the place to start. It's pretty eye-opening.
It really is. I mean, get this. Their cumulative return right through Q3 2025 is a massive 171.25%.
Whoa.
Yeah. And compare that to the S&P 500 over the same period, just 68.61%.
That's quite a gap. And it really speaks directly to their main goal, what they call their North Star, doesn't it?
Exactly.
Which is all about maximizing the portfolio's value long-term by, consistently beating that benchmark.
And they're certainly walking the talk based on these numbers. That compounding difference is just staggering.
It really adds up.
We're looking at a 34.90% compounded annual gain for them versus what? Just under 17%, 16.97% for the S&P 500.
Right.
Put it in real terms. If you started with $100, you'd be looking at $271,250 with Capital Alphabet now.
Compared to maybe $168,610 with the index fund,
Yeah.
That's a serious difference in your pocket.
Huge difference. Now, you don't get that kind of outperformance by accident. There has to be a solid strategy. Let's dig into their investment pillars.
Yeah, they lay out 5 core components. It's very disciplined, sort of a classic value investing approach,
Yeah.
but they seem incredibly strict about applying it.
Okay, so what are they looking for?
Well, high-quality companies, obviously.
Mm.
Businesses with substantial economic moats, strong competitive advantages. High return on capital employed is another big one. And crucially, a huge margin of safety in the valuation.
The huge margin, not just a margin.
Exactly. They emphasize that. And the 5th pillar, which is interesting, is that the companies must be run by trusted management.
Trusted management, what does that mean in their terms?
Well, the fact sheet clarifies it. They want leaders who really prioritize consistent shareholder return, not just chasing, say, short-term growth stories or empire building.
Okay, that makes sense. And then their risk rules. These are almost blunt.
Yeah, they are. Simple but powerful. Rule number 1, never lose money.
The classic Buffett rule.
Pretty much. And rule number 2, only make bets on absolute no-brainers, things they're highly confident will beat the index long-term.
And then the kicker. Never forget rule number 1.
Never forget rule number 1.
So how do you square that circle? This incredibly aggressive 171% return with never lose money seems contradictory on the surface.
Well, I think the key is in that second rule. By setting the bar incredibly high, only betting on no-brainers with those wide moats and safety margins, they believe they're inherently minimizing the risk of permanent capital loss.
Okay. So the strict selection is the risk management.
Precisely. It enforces discipline, conviction, and, they hope, protects the downside while maximizing that long-term compounding.
Got it. Okay, let's shift from the what to the how. How is this actually structured for clients? It's a separately managed account, right? An SMA.
Exactly. So you, as the client, actually hold your assets in your own brokerage account. They mention IBKR Interactive Brokers as a typical platform.
So the money stays in your name.
Yes. And then Capital Alphabet gets discretionary trading authority over that account. It gives you transparency and direct ownership, which many clients appreciate.
And getting in, what's the minimum? I saw they lowered it recently.
They did. It's down to $25,000 to start now, though they do recommend having over $100 K in there for, optimal diversification and results within their strategy.
Right. Makes sense. Okay, now the fees. This part is really interesting, especially the split approach.
Yeah, this really shows where their focus lies, perhaps.
Yeah.
For what they call qualified clients, typically higher net worth individuals meeting certain SEC criteria, there's no annual management fee based on assets. 0.
No AUM fee at all.
None. It's purely performance-based. They take 25% of the annualized profit the account makes.
Okay, 25% of the profit.
But, and this is a big but, only on the profit above a 6% annual hurdle rate.
So the account has to make more than 6% in a year before Capital Alphabet sees a dime.
Exactly. The idea is you should be getting that first 6% basically risk-free or close to it elsewhere. They only want to get paid for generating returns above that baseline.
That aligns incentives pretty strongly.
Very much so. And they use a high watermark.
Crucial. Explain that quickly.
It just means if your account value goes down 1 year, they don't earn any performance fee the next year until the account value gets back above its previous peak. They only get paid on new profits, not just for recovering old losses.
Okay, so that's for qualified clients. What about everyone else, the others?
For them, it's a more standard structure.
Yeah.
A 1.5% annual management fee based on the assets under management, AUM. No performance fee component there.
Right. So wrapping this up, we see this really impressive performance, that 171%, driven by this focused compounding strategy.
Yeah, aggressive results.
But it's all anchored by these super strict, almost defensive rules like never lose money and only betting on no-brainers. The discipline seems directly linked to the outcome.
Absolutely. The rules and the results seem tightly connected.
Which leads to maybe the final thought for you, the listener, to chew on.
Mm-hmm.
Given this setup, especially the fees, why have these two different tracks? You've got the performance-only fee, really aligning them with qualified clients.
High alignment, high conviction needed.
Right. And then the standard 1.5% AUM fee for others. What does that signal?
Yeah, what does that choice imply about their strategy as a business? Are they maybe more focused on just gathering assets quickly with a standard fee structure? Or is the real focus on that deep alignment with clients who opt for the performance fee?
It makes you wonder where their primary drive is, scaling the firm or sticking to that pure performance-driven alignment. Something to think about.